He is BlackRock's CIO of Global Fixed Income and head of the Global Allocation Team. It's good to have you, and it's good to have you back here post 9. Okay, so your thoughts on stocks at record highs?
Yeah.
What are
So can I go to something Joe said?
Yeah.
People don't realize 110 billion of an authorized stock buyback. The average S&P 500 market cap, strip out the Mag 7, is 65 billion. They're buying 2 S&P 500 average-sized companies per annum. That number is staggering. By the way, I was looking at the whole market cap of the New Zealand stock market is like 90 billion. What they're doing, it's pretty incredible. By the way, you take the other Mag 7, I looked at 4 of them. They're buying back 320 billion of stock. The IPO calendar is 13 billion. The technicals in the equity market are truly staggering. So, listen, I think the earnings, the revenue sales wasn't that good. I mean, if you go and we talk about retailers, we talk about consumer, wasn't that good, but the earnings are actually pretty good. There's stickiness to margins, the software development, AI implementation, et cetera. It's pretty impressive. Earnings are still pretty good. And so anyway, I know we've talked about it a bunch of times. I think people underestimate. You got an incredible technical in equities, and you're still throwing off 18, 19% ROE for the average S&P 500 company. It's pretty impressive.
Okay, so you were on with me, I think, right around the time of the April low. And I asked you your views on the markets, and you just said plainly, equities are going higher.
Yeah.
What made you so sure?
Yeah.
And is it earnings, the reason why?
So, I mean, it's two things. I mean, so I've learned in my career, sometimes the hard way, that the technicals matter arguably more than the fundamentals. When you buy back that much stock, $1 trillion of equity buyback against 13 trillion IPO calendar, and you think about just normal, there's 9 trillion of money sitting in cash, the normal wealth creation, salary, X amount goes into 401k, the technicals are pretty good. The other side of it is, and we'll talk about consumer, there is definitely some moderation that you're seeing in the consumer. But gosh, when you talk about this sort of earnings, this persistent ROE, and you're buying back, think about what the equity market is today. It is functionally taking top-line revenue, or top-line GDP of the economy, running at 4.5% to 5% nominal GDP, and it's an operating leverage machine that's throwing off, what are terrific earnings. So anyway, I still think it's going higher. Listen, is the multiple a figure too high? I think so, but I also think you'll work your way through that pretty quickly.
How much higher? What makes sense?
So, if you said to me, how much more will I get? And we'll talk about what would you do in a balanced portfolio today? Could you get another 10, 15% of the equity market this year? I don't think it's much of a stretch at all. Could you get a bit more than that? Yeah, I think you could.
10 to 15%, not much of a stretch at all. And that's because of continued earnings power, along with all of these other levers that we see at play, whether it's buybacks and CapEx and everything else?
So I think it's the buybacks. I think it's the fact that the earnings are still pretty good. And listen, I do think as you get to the back half of the year, there's such an incredible focus, which I think, by the way, too intense about where the interest rate is. My sense is that we're moving to a Fed that's put the bar high for raising rates and would like to still get another cut or two in. And I think when people see that, you'll get another push in terms of the equity market. Listen, I'm not saying like jump all in today, given the move we had, but I do think you can build a balanced portfolio. And I would hold equity certainly for the next couple of years, and they'll do their job.
Do you think cuts matter at this point?
So, I mean, I'll say one thing about, I've looked at companies for almost 40 years now. Companies today are not terribly sensitive to the interest rate move. They termed out their debt. You think about how low rates were. Most companies turn their debt out. Actually, a lot of companies are sitting on huge amounts of cash that are benefiting for these high interest rates. The places that are the cyclical parts of the economy are definitely, you've seen some pressure in a lot of the cyclical parts of the economy. You're seeing that now in the consumer. But companies are much more insensitive to interest rates than they've ever been before. Listen, markets will react to it. If you start to get those cuts, markets will react. But I think people will be surprised, like they've been heretofore, that if rates stay about where they are, the equity market can move along.
Is that one of the biggest surprises, you think, that, expectations or fears that if you keep rates as high as they've been for as long as they've now been, that ultimately you would have corporate rollover, so to speak? They would just fall under the weight of these heavy and high rates. You're suggesting counterintuitively that they've actually worked in their favor in some respects.
Pretty extraordinary. So you think about where we've come from. Well, since World War II, the largest transfer of money from the public sector to the private sector, massive amount of money that flowed through to households and corporates, and you kept interest rates extremely low, too low for as long a period of time. Companies termed their debt out. So now you have this dynamic. I always think it's funny when people come on the show and they say, gosh, if we go to a 3.5% 10-year, the equity market can't take it. If we go to 4.5 is the number. it's just not that impactful. You think about the Mag 7. They fund their capex or R&D through free cash flow generation. They're not borrowing to. They do some borrowing to make sure their balance sheet, the cap structure of their balance sheet is right, but they're funding what they're doing through free cash flow. So I just think it's grossly overstated. In fact, I think much of the economy today is benefiting from high interest rates. High income is, you see that in all the interest income coming in.